There's a moment that happens every spring in millions of households. You sit down with a folder of documents, W-2s, 1099s, a brokerage statement you barely remember opening, and within 20 minutes, you reach for your phone and book an appointment with someone else. Now think about who you are in every other room. You manage budgets at work, you read contracts, you make decisions involving more money than your tax return will ever touch. And yet, in front of your own financial life, you fold. Most people file that moment away as a personal failure, a gap in their education, a subject they should have studied harder. Tonight I'm going to show you the math that proves it isn't. The confusion you feel was engineered, measured, priced, and sold back to you. And by the end of this video, you'll be able to calculate what that engineering costs you per year in your own statements. Start with what you've always believed, because it's a reasonable belief. The financial world is complicated because money is complicated. Tax law has to cover 300 million different lives, employees, founders, landlords, retirees, so of course the code is thick. Markets price risk across an entire planet, so of course the products are dense. And a sane adult responds to density the way sane adults respond to everything they can't master personally. They delegate. You don't perform your own surgery. You don't represent yourself in court. So you hire a preparer for the taxes and an advisor for the portfolio, and you call that maturity because it is. It's the same logic you apply to medicine, to law, to the engine of your car. Specialization is what an advanced economy looks like, and hiring help isn't surrender. It's how the division of labor works. The professionals went to school for this. They sit inside the system all day. The hour they spend on your return is backed by 10,000 hours you will never have to spend yourself. There's even comfort in the handoff. The moment the documents leave your hands, the anxiety leaves with them. You're not lazy. You tell yourself, and you're right, you're allocating attention, the scarcest resource you own, to the places where it earns the most. And underneath this entire arrangement sits a quiet assumption you've never had a reason to examine, that the complexity is natural. Nobody built it. It accumulated, the way weather accumulates an environment, not an artifact. The experts aren't part of the weather. They're simply the people who learned to read the sky. Now look at one piece of evidence that doesn't fit. Every 3 years, the FINRA Investor Education Foundation gives American adults a financial knowledge quiz. 7 questions. Not derivatives, not offshore structures, questions like this. If your savings account pays 1% interest and inflation runs at 2%, can you buy more, the same, or less with that money after a year? In the most recent study, more than 25,000 adults across all 50 states took that quiz. The average score was 3.3 out of 7. 27% of respondents managed to answer at least 5 questions correctly. 4% answered all 7. And the inflation question, arguably the most basic measure of whether a person can read their own financial weather, was answered correctly by 58%. Now hold that result against the timeline. This study has been running since 2009. Across those same years, financial information went from scarce to effectively infinite. Every concept on that quiz has been explained for free in tens of thousands of videos, articles, courses, and forums. If the complexity were natural and the problem were education, free and unlimited information should have closed the gap. It didn't. The scores drifted downward. In 2009, the average respondent scored the equivalent of 60% a passing grade, barely. The most recent average works out to about 47%, a failing grade on a quiz about the money in your own wallet, earned during the most information-rich years in recorded history. The gap held its shape for 15 years, held it the way a wall holds, like something load-bearing. And that forces a question this entire video exists to answer. If the public's confusion has survived the greatest expansion of free information in human history, then maybe the confusion was never a failure of the public. Maybe it's a property of the structure. Don't close that wound yet. First, the mechanism needs a name. The mechanism is called the complexity dependency trap, and it operates in 3 movements. Complexity accumulates, comprehension can not keep pace, and a paid layer forms in the gap between them. Begin with the accumulation, because it's countable. The federal tax code was trimmed to roughly 3.96 million words by the 2917 tax reform, the largest simplification effort in a generation. Within a few years, pandemic-era provisions and new deductions pushed it back up to about 4.26 million words. Read that sequence again. The biggest simplification in decades was absorbed and reversed in under 10 years. That isn't an accident of politics. It's the metabolism of the system. Every rule enters as a fix, a credit for this, a phase out for that, a threshold, an exception, a sunset date, and each fix is individually defensible. No one votes for confusion. But every fix adds a sentence. Every sentence interacts with the sentences already there, and interactions are where comprehension dies. The most recent major tax bill alone is estimated by the IRS to generate nearly 26 million additional hours of compliance work. 26 million hours, created by a single law. Now the second movement, the gap. A system this dense exceeds the comprehension bandwidth of the people who are legally required to use it. According to the latest federal estimates, Americans will spend about 7.1 billion hours complying with tax filing and reporting requirements this year. That is the equivalent of 3.4 million people working full-time and doing nothing else, a workforce the size of a major city, employed entirely by paperwork. And whenever a mandatory system exceeds what its users can navigate, a market forms inside the gap. That's the third movement, the intermediary layer. In the United States, the portfolio management and investment advice industry collects an estimated $603 billion in annual revenue. There are more than 320,000 financial advisors. Households spend roughly $148 billion a year out of pocket just to comply with the tax code software, preparers, accountants. Add the value of the time to the money, and the total compliance burden runs past $500 billion a year, on the order of 1.7% of the entire economy. Hold on to one number from earlier because we're coming back to it at the very end, 27%. Here is where precision matters about who the villain is, because it is not the person across the desk. Your CPA did not write the code. Your advisor did not design the share classes. Most of them spend their careers translating a language they didn't invent, and many of them privately resent its density as much as you do. Forensically, the villain is the architecture, and the test of an architecture is not intent but incentive. Ask one question of every actor with the power to simplify the system. What happens to their revenue if they do? The software company whose product exists because filing is hard. The advisory firm whose fee is justified by the density of the prospectus. The professional bodies whose credentials hold value in proportion to how impenetrable the field remains. The legislators for whom narrow technical provisions are how favors get delivered. None of these actors needs to coordinate. None of them needs malice. They only need to never be the one who volunteers to make the maze shorter. A toll booth doesn't have to build the road. It only needs the road to run through one gate. And notice the vocabulary itself, because vocabulary is the cheapest wall ever constructed. To move money into a retirement account, you may encounter expense ratios, front-end loads, 12b1 fees, wrap fees, surrender charges, 5 different terms for the single act of paying. Complexity in pricing isn't ornamental. A fee you cannot name is a fee you cannot compare, and a fee you cannot compare is a fee that never has to compete. The structure doesn't hide the cost. It shreds the cost into pieces too small and too technical to reassemble. That is gatekeeping in its modern form. Not a locked door, but a hallway with enough turns that you hire a guide gratefully, voluntarily, year after year. The trap then completes itself through the asymmetry of error. If a professional makes a mistake on your return, there is a process: insurance, amendment, routine. If you make the same mistake alone, there is a penalty and a letter that reads like an accusation. The system prices individual error higher than delegated error, which means that even a person fully capable of learning the rules is acting rationally when they choose not to. Sit with that, because it is the heart of the mechanism. The structure makes your dependence the intelligent choice. You aren't dependent because you failed. You're dependent because, inside this architecture, hiring the guide is the correct answer to a test you never agreed to take. And dependence, once normalized, removes the last source of pressure to simplify, because a population that has stopped trying to read the rules also stops demanding that the rules be readable. Consider Daniel, 48 years old, operations director at a regional logistics company. Household income of $172,000 a year between his salary and his wife's part-time consulting work. 2 teenagers, 15 and 17. A mortgage in its 14th year. His emotional baseline, if you had to give it a name, is competent helplessness, a man who runs a warehouse network across 4 states and cannot tell you within $5,000 what he paid in financial intermediation last year. At 36, Daniel made a rational decision, the kind this channel never mocks. His financial life had crossed a complexity threshold: compensation, his wife's consulting income, a rental property held for 3 years, and so he did the responsible thing. He hired a CPA, $610 a year for the return, almost exactly the national average for taxpayers who itemize. And he signed with a fee-based advisor at 1% of assets under management. The conventional wisdom arrived with the engagement letter: professionals pay for themselves. The fee is small. The mistakes you avoid are large. 12 years later, the portfolio sits at roughly $480,000. 1% of that is $4,800 a year, about $1,200, posting out of the account on the first business day of every quarter, a withdrawal he never writes a check for and therefore never feels. For context, take the regulator's own illustration, not a critic's. The SEC's investor bulletin models $100,000 growing at 4% for 20 years. At a 0.25% annual fee, the portfolio ends near $208,000. At a 1% fee, it ends near $179,000. The difference is roughly $29,000 on a single $100,000 in the government's own teaching example. Daniel has read none of this, because the quarterly deduction has a property the engineers of fee structures understand deeply. Money you never touch is money you never count. Then comes the march that breaks the pattern. His wife's consulting generates a K1 for the first time, and Daniel, a man who builds routing algorithms for a living, decides he will do the return himself this year. He blocks out a Saturday. The Saturday becomes a weekend. The weekend becomes 9 hours across 2 weekends, and the wall he hits is not arithmetic, it's classification. Which worksheet governs the income? Whether a deduction phases out at his bracket. Whether an answer that seems to apply actually applies, because every answer he finds opens 2 further questions beneath it. On the second Sunday night, he runs a different calculation, not the return, but the exposure. If he gets this wrong, the cost is penalties, interest, and the specific dread of a thick federal envelope with his name on it. If the preparer gets it wrong, there's an amendment process and someone else's signature on the line. He closes the laptop at 10:40 p.m. and emails the CPA, and somewhere around 11, the understanding arrives, cold and complete. He is not paying $610 for knowledge. He could acquire the knowledge, he just priced it, at 9 hours and rising, with no ceiling in sight. He is paying for indemnity against a system he cannot verify. And the advisory fee, he realizes, is the same purchase at larger scale, $4,800 a year. Not for returns, the SEC's own math says the fee subtracts from returns, but for the right to stop being responsible for a structure that punishes his errors more reliably than it rewards his understanding. That night, he finally adds up 12 years of invoices, smaller in the early years when the portfolio was small, compounding as it grew. The total comes to a little over $51,000. He doesn't feel cheated, exactly. The work was done. The returns were filed. Nothing was hidden from him. What he feels is stranger than cheated. He has paid $51,000 for permission to participate in his own financial life, and he cannot locate the moment he agreed to the terms. The next morning, he re-signs the advisory agreement. There was never really another option on the table. That was the point. Now scale Daniel by the country. 7.1 billion compliance hours a year, 3.4 million full-time equivalent workers producing nothing but filed paperwork, $148 billion in direct out-of-pocket spending, and a total burden past $500 billion annually in economy. Within the economy, whose revenue is proportional to one variable, the distance between citizens and their own financial rules. Every industry defends its revenue. This one is no different. The distinction is what its revenue is made of, and the layer is not static, it is expanding. The number of advisory firms operating in the United States rose 5% in a single recent year, past 21,000. And the broader advisory market is projected to grow faster than the economy it sits on top of for the rest of the decade. Think about what that growth rate implies. The translation business only grows when the document keeps getting harder to read. The forecast for the intermediary layer is, in effect, a forecast for the complexity itself, and the forecast is up. You can measure the lock by looking at the simplifications that already exist and don't arrive. In a number of countries, the tax authority sends citizens a pre-filled return. The government already holds the wage and withholding data, so the citizen reviews and signs. In the United States, for tens of millions of straightforward salaried households, the government likewise receives the numbers before the taxpayer ever types them in. The persistence of manual complexity in the presence of available simplicity is the cleanest field measurement of this mechanism you will ever get. Nothing technical prevents the shorter road. The toll booth does. Run one hypothetical and label it as one. Imagine a rule that any financial product sold to the public must be explainable on a single page to a median reader. One comparable fee number, one plain language risk statement. In that world, products compete on substance. Fee structures collapse into figures that can be ranked side by side. The revenue currently earned inside the comprehension gap, the translation layer, the navigation layer, the reassurance layer contracts toward whatever value it actually adds. The fact that you already know instinctively that this rule will not arrive in your lifetime is not cynicism. It is your accurate reading of who would have to approve it. And note who carries the weight in the meantime, because the burden is not distributed evenly. High net worth households buy the best guides, and the code's complexity is where their advantages live: the carve-outs, the structures, the timing strategies. Middle households pay proportionally more of their time and a larger share of their income for basic translation, and receive the standard route through the maze. The intermediary layer is not parasitic on the wealthy. It is rented by the wealthy and billed, hour by hour, to the middle. You came into this video carrying a definition, even if you never said it out loud. Financial advice is a knowledge product. You pay an expert, and what you receive is expertise. Replace it. Inside this architecture, what you are buying most of the time is not knowledge. It is passage. The fee is not the price of wisdom. It is the price of distance, the measured, maintained distance between you and the rules that govern your own money. That distance was not your doing. It is 4.26 million words long. It grows every legislative session, and it generates more than $500 billion a year for the layer that ferries people across it. Now take back the number I asked you to hold, 27%. When you first heard it, you probably filed it the way it's usually reported, as evidence that the public is bad at finance. Read it the other way. A mandatory system in which 73% of users cannot pass a 7-question quiz about its most basic operations is not assist failing. As architecture, it is performing. The quiz doesn't grade people. It grades the structure, and the structure scores exactly as built, which quietly retires a sentence you may have carried for years, repeated in the car after meetings you only half understood. I'm bad with money. On the evidence, you are a normal reader standing in front of a document engineered past readability, being charged for the difficulty, and then handed the bill for the shame as well. Will you still hire help? Probably, and inside this structure that remains the rational move. This is not a video telling you to fire anyone, and the person across the desk is, in most cases, a translator rather than an author. What changes tonight is smaller and sharper than a decision. It's the question you bring to the invoice. Not was the work good, but what exactly am I paying for knowledge or crossing? Once you can tell those two apart, the fee never reads the same way again. The complexity stops being weather. You can see the construction seams. You can see that someone poured this, section by section, fix by fix, and that every section had a beneficiary who was not you. Nothing about your account balance changes in that moment. Everything about the blame does. So here is the lucid version. With the temperature turned all the way down, the confusion was never yours. It was manufactured upstream, delivered to your kitchen table every April, and the cure was sold separately. You were never bad with money. You were billed for a distance you didn't create. Complexity creates dependency that is the mechanism, and now you can see it. But watch closely what happens at the exact moment a person stops trying to understand. Giving up, it turns out, is also a purchase. The system keeps a product waiting for precisely that moment, and it carries a friendlier name than anything in this video. It's called convenience. Next time, we count what it actually costs.